Hi everyone, I'm Winnie C., your host for today's webinar, Women and Money, It's Our Other Significant Other. Joining me are Bonnie Humphrey, Executive Vice President and Chief Fiduciary Officer for AAFMAA Wealth Management and Trust, and Carrie Clark, Senior Relationship Manager for AAFMAA Wealth Management and Trust. We have about 30 minutes of slides for you today, and then we'll leave plenty of time for your questions. Since you are muted, please ask your questions by typing them into the questions block on your screen. This monthly webinar series is brought to you by AAFMAA Wealth Management and Trust. We are AAFMAA's trust company. AAFMAA stands for American Armed Forces Mutual Aid Association, and it's the longest-standing not-for-profit association that empowers military families with affordable financial management. We accomplish this by being the premier provider of financial planning, investment management, and trust services for the military, not-for-profit. Also, as a trust company, we have an additional legal obligation to act as your fiduciary, which means we only act in your best interest and for your benefit. Here's an important disclaimer. This presentation is educational. It is for general information only and is not specific investment, legal, or tax advice for any of you individually. Do not rely on this presentation alone to guide your financial planning decisions. Since each individual situation is unique, your needs for financial services will differ. For individual advice, please contact us directly. We produce this webinar series in-house with our own professional staff as a service to our members and to help others better understand the resources that are available to them. I will now go ahead and turn it over to Carrie, who will go over the agenda.
Hi, thank you, Winnie. Good morning, everyone, and thank you for joining us. Today's agenda is pretty packed with some fun information about women and their money as another significant other. Winnie has started with who we are. We'll turn it over to my colleague Bonnie to talk about why we're here. We'll go on to discuss dispelling some common financial planning misconceptions. We'll talk about how many significant relationships can one woman juggle. We will discuss why money is a significant relationship for women. We'll discuss women in finances, how that's played out in our industry and certainly in the military. Women in financial planning, women and investing, and finally, where to begin. At the end of the session, we'll take some questions, and if we can't get to your questions, we will certainly follow up. So now I'll turn it over to Bonnie to discuss why we are here.
Okay, Carrie, thank you, and Winnie, thank you for the introduction. The why we're here for me is very personal, and that's what this picture is. That is a very, very long time ago. Yes, it is me, the day I was commissioned an officer in the Navy with my dad who commissioned me. But that's the core of why I'm here and why I think Carrie's here and Winnie is here and the entire team at AAFMAA Wealth Management and Trust. There's a very long history of caring for the military family. And I've been in this business a long time, as has Carrie, and we've come to recognize that you care in different ways and there may be different approaches to get to the same end. So what we want to focus on in the context of watching out for military is why do women have different thoughts about money, look at it differently, and maybe need to proceed a little bit differently as they selected advisors and invest. This presentation was developed to be done face-to-face, actually, where we had feedback from an audience and as a tag team. So we're going to do it as a tag team presentation. Carrie will take a slide, I'll take a slide, so you don't need to listen to one of us the whole time, and we'll see how that goes. So I'm going to go back to Carrie to talk about what are some common financial planning misconceptions.
Thanks, Bonnie. Great picture. Common financial planning misconceptions, specifically with respect to women, is that it's not that we as women don't know what to plan for. We probably spend as much time as our male counterparts thinking about, stressing about, losing sleep over the things that we should plan for with respect to our finances, children's education, retirement, caring for our aging parents, long-term health care needs for ourselves and our spouse, and any legacies that we want to leave to our family or to the charities that are important to us. So the misconception that women don't know is frequently, something that we deal with when we talk to our clients. They do know. They do know what they need to plan for. It's that they don't know how to plan or where to start the planning process. And Bonnie, back over to you.
What that's led us to understand is that women are busy juggling any number of things. So to our minds, how many significant relationships can one woman juggle? How many things are we trying to deal with at the same time that can take attention away from the others? First and most obvious perhaps is spouse and partner. The relationship needs nurturing, needs to have some time devoted to it. Children, absolutely. And we were just talking before the call started about infants are easy sometimes. It's as your children grow, as they become adults, those are significant relationships. Take time and attention away from other things. Aging parents. We talk about the sandwich generation where women are caring for quasi-adult children as well as aging parents. Squeezed in the middle, no time to think about other things. Friends are relationships that take time. Siblings take time in your relationships. Career it can be a big time user in terms of trying to balance things. But what's left is money. Money is a significant relationship. And when we put this presentation together, we started to think about why is money a significant relationship? Because it's not a person. But how do we as women look at money, and how does that affect the way we invest, the way we think about picking advisors, and our comfort level with things? Really, why is money a significant relationship for women? Carrie?
And there are several reasons why it's a significant relationship. The first is that dealing with money takes patience and sacrifice, like any other relationship, but it's not a once-and-done transaction. So when you're planning for your financial future, you can't just make a plan and let it run on autopilot. It really is something that takes patience and sacrifice over time. It's significant because you get out of it what you put into it. So the more knowledge, effort, and understanding that you put in to your financial planning, the more that you'll get out of it, not just as far as growth, but just a general understanding of where you're headed and how you're going to get there. Money can be controlling or supportive. So I'm sure that we have callers who have had times in their lives where waiting for the next payday kind of controls their ability to spend. And so when you don't have a lot of money or you're living paycheck to paycheck, it can be very controlling. At the same time, it can be very supportive. So a nest egg and a sense of comfort if you have enough to secure whatever your goals are, retirement, education planning for your children. It takes work to understand and maximize the benefits of your financial future. Just like any relationship, you have to work at it to really make a significant impact on your financial picture. It's not always easy. So, when there is a downturn in the market, there are times when people are not comfortable with the level of risk that they've taken on, or looking at the value of their financial portfolio decline. It's not always easy to budget. Sometimes, you know, the things that are important and have to be budgeted are take away from the luxuries that we would like to enjoy. Some days it's better than others. I can say the same thing about my relationship with my husband. So it is a significant relationship in that regard. You will like your plan one day, and a month later it may not seem as stable as you'd hoped. Sometimes it requires too much attention. Sometimes it is consuming. And when this happens, this is what we do, is step in and assist members of the American Armed Forces with how to plan efficiently and how to take some of that load off of you and assist you in making it not something you that requires your constant attention. It's just one more thing that you may not have the time or energy for. So juggling all of the different relationships Bonnie just mentioned, sometimes and more often than not, we find that money and investments take a back seat to what's important, what's right in front of you, a child, an aging parent. And when it takes that kind of back seat, it sometimes can go astray. And that's why it should never run fully on autopilot. I mentioned that earlier, but it's not a once and done transaction. It is something that has to be monitored and changing as you and your lifestyle changes over time. And there's no one right way to deal with money. It is very individualized. So what works for you may not work for me. It may not work for a colleague. And what we found often is that as Bonnie and I have been out and talking to women in the military, is they've said things like, well, I asked one of my peers how they invested in their TSP and just used their investment allocation. And that is probably not the best approach and strategy, because everyone's needs are very different. And so to say that it works for one and not for another, it's like, trying to fit a round peg in a square hole. So with that, I'll turn it back over to Bonnie so she can continue about the significant relationship of money and women.
Yeah, we're not done yet. There are still other reasons why money is a significant relationship and needs time and attention. First of all, it's going to react to outside forces beyond your control, and that's really hard to take sometimes. Typically, the markets, you know what you want your money to do, you know what you're intending it to do, and there are outside effects that you just can't stop. So it's frustrating, and sometimes the result of that and the response to that is not to want to invest, not to want to be in the markets at all, not to want to make any investment decisions because you can't control it. But believe me, you can't control it at all if you're not working it. Money may require professional assistance to keep it running smoothly, whether at the beginning of an investment approach to work with advisors, to work with professionals, to decide what's best for me, what do I need to think about, or ongoing relationships to keep this process going smoothly. Because it is a significant relationship, there's a lot of emotion involved. And what Carrie and I and others have found over years of working with people on investing and planning is that you need to keep that emotion out of your decisions. And emotion is a big part of significant relationships. It requires continuous active engagement. Again, this is the third time we've said it because it's important, just a different way. You don't do it once and forget it. You have to stay engaged. For money to work for you and to do what you want it to be doing, you need to stay engaged. It's not an autopilot, not, okay, I've set my portfolio and I can sit for the next 35 years. You need to be actively involved. money works best as a team approach. And that's the result of a couple things I just talked about. The continuous active engagement. When you're working with a team, if you're not of the mindset or the place in your life where you can devote a lot of time and attention to it, your team, your partner can help you do that. And that team might be a professional to help you get things up and running. It might be within your family, but it's not a one-person project either. Very, very dangerous to compare the outcomes of your money decisions with others. Same way we say we shouldn't compare kids. You know, one kid's doing this, one kid's doing that. Can't compare it. Follow up on what Carrie suggested, asking someone for advice on how to invest and taking theirs. Not a good choice. You are a unique person, that you are going to be choosing an advisor, making investment decisions based on what's important to you. So very, very dangerous to compare outcomes with others in terms of your money decisions. A little bit on the softer side, but it's important to remember that money and your relationship with money is going to be colored by what you saw in other relationships. And the corollary to that is the nature of your relationship with money is going to be observed and internalized by your kids. And I think if you think back on what you learned from your parents about money and what you're imparting to your own kids, you can see where that's important, is that kids pick up on attitudes. I think, you know, a lot of the sociological studies were done that people who grew up during the Great Depression had a very different attitude toward money in terms of what was available, what wasn't available, how their parents used it, and those trends stayed with them throughout their lifetime. So your decisions about money and whether you control it or it controls you are going to be internalized by your kids, and there's something that you've picked up from your parents and you're going to be passing down as well. Most importantly, you have to determine what works for you. Just as there is no one-size-fits-all, there's no one right way to do it, you are going to come to terms with how you handle your money, how you invest it, how you spend it, how you don't spend it, that works for you. Not for your spouse or partner, not for your sibling, not for your best friend. What works for you is going to be the right decision. One of the things we hear all the time is, what's the one right choice? And the answer to that is, there is not one. There's variables. What you choose, as long as it's done in a considered way, will never be an incorrect choice. So let's talk about women in finance now. We've talked about money as a significant relationship. How does that play out in our daily lives? Carrie?
Great. And the little cartoon is, I didn't get where I am by trying to please. Bonnie and I get a kick out of that. I'm sure our colleagues do as well. So women in finance, why is this an important topic? What are some misconceptions or, in fact, facts? The first is that a lot of times women lack confidence when it comes to financial matters. It's perceived that there's an inaccessibility in a male-dominated financial world. That's changed. I've been in the business for 20 years and have seen many women moving into more senior management positions in large firms, but still, when we're working with clients, a lot of times we do see that women kind of take the back seat, even in a marriage, in a spouse relationship. So they seem to lack confidence because there are some, terms and technicalities about the financial world and about financial planning that they maybe don't have a strong grasp on. So in order to combat that, we need to start talking and asking more questions, not continuing to take a back seat. Another misconception or another thing is that women do sweat the small stuff. And we focus on the nickels and dimes. We're the coupon cutters. And that shifts our focus from a retirement or a long-term investing strategy to something more day-to-day. So instead of, not that people shouldn't sweat the small stuff or to diminish a woman's, that she does sweat the small stuff, but long-range planning is important to focus on. A lot of times, and we see this a lot with some of our more elderly clients in the World War II generation, so to speak, that they're just waiting for someone else to fix the problem. They've had a spouse or a partner that's handled their finances for their entire marriage, and then something like a death or a divorce causes them to have to address these things at a point in their life where it's not something that they want to learn and they're forced to. About 70% of the baby boomer generation, the women are going to outlive the men. And that's why it's very important that women become more well-versed and start talking more about finances and financial planning so that they can step in and handle the finances and not be drinking through a fire hose when an unexpected event causes them to have to step up. And for women, we're typically focused on goals, not numbers. So we know that we want to pay for our children's education, but we need to determine the what before we determine the how. So we focused on that goal, but we haven't focused on the how. And that's where learning more about finances, becoming more well-versed in the financial sector can help us, because focusing on that goal actually makes women better investors. Being focused on a goal is what we would recommend instead of focusing on the numbers on your statement every month. Focus on the long-range goal and how we're going to get there. And so when women actually do become engaged and learn the process, they do make better investors because they're not focused on the number at the end of the month, rather the long-range 10-year, 20-year goal. And so now I'm going to turn it back over to Bonnie to talk about women in financial planning.
Thanks, Carrie. And that focus on a goal rather than a number extends into financial planning. And the terms financial planning mean a whole lot of different things to a whole lot of different people. But similarly to saying focus on goal, not number, remember that financial planning is a process and not a product. Sure, if you have a financial planning engagement and you're working with an advisor who says he or she is doing a financial plan, what you expect at the end of it is this big binder that's going to probably, unfortunately, sit on your bookshelf with lots of reports and lots of numbers. That's the product. Financial planning, the importance is the process, not what you have at the end of it. And good financial planning is designed to provide direction and structure for your goals. So you can see how this concept meshes. We're not focused on numbers. We're not focused on the piece of paper. We're focused on what it's telling us throughout the process. And it's always going to be changing. Sometimes clients will say, I don't need to do a financial plan because financial planning is only for rich people. And the answer is no, financial planning is not just for rich people. It's really a necessity rather than a luxury. And it's a valuable exercise regardless of net worth. And I'm going to go right back to the first bullet point, because it is a process that's designed to provide direction and structure, and not here's what you need to do tomorrow and you'll be fine. So we really see financial planning as a necessity and something everyone should be thinking about. Financial planning, however, is not an exact science. And again, goal rather than numbers. Good financial planning is a mix of the qualitative and quantitative, okay, mix of the objective and subjective, mix of the gut and the hard numbers. When I'm sitting down with clients to do a financial plan, they might be surprised, because at the first meeting, before we start looking at the pages of numbers, I'm going to tell them every number on these pages is wrong. And I get a horrified look back, thinking, well, why are we doing this? It's wrong because nobody can tell you that in the year 2025 you're going to be spending $265.45 on your magazine subscriptions. I think when you focus on the numbers only in a financial plan, it's not helping you. It's a mix of that qualitative. What are you thinking about? What are your goals? How do these things fit? The financial plan becomes valuable. And despite what some people might think, if we look at the picture here, which is a thing I would really love to have for office naps, financial planning is not boring. Don't hide your head. Don't be scared of it. A lot of people think, a lot of women in particular, I don't understand the numbers. They're going to be throwing things at me I don't know. It's going to be boring, so I'm just going to sit back and not ask questions. It isn't boring. It's how you are going to achieve your goals that are so important to you. So don't hide your head. Where you have the opportunity to engage in a well-structured financial planning process, absolutely take it, because you'll learn a lot, and I think you'll surprise yourself and you'll find you're not bored. Once we understand the financial planning path and start talking about how some of our goals can be met, one of the tools for doing that certainly is investing. And that's where a lot of women may shut down because of lack of knowledge. So, Carrie, let's talk about women and investing a little bit.
All right. Thank you, Bonnie. Investing can be kind of that, I don't want to touch that. I don't know. I have so many people saying, I'd rather it just sit, in a box or stuffed under my mattress before I have to learn about the stock market. So women and investing can be difficult. What we recommend is that one of the first steps to kind of becoming less intimidated by investing is to become familiar with the basic investment terms. When Bonnie and I do this presentation live for women, we provide the women with a glossary of some of the basic investment terms that we would use every day that can help them become familiar. And certainly if you're interested in that glossary that we've created, just send us an email. Winnie will provide the email address at the end of the presentation, and we'd be happy to email you the glossary. Investopedia is a website that also has, a broad, huge library of terms. But in going to that website, you'd need to know what terms to look for. So we've kind of cherry-picked the ones that are most common, and we'd be happy to send that glossary to you. By becoming familiar with these basic investment terms, you can start to invest with more confidence. And that, that confidence is what will lead to success and help you develop relationships with advisors where you don't feel as if you are being spoken down to or someone's talking above your head. So having that confidence in investing can go a long way. And we would recommend that you watch out for some common and preventable mistakes that any novice investor may make, but women in particular, if they become kind of intimidated by the market, these are common mistakes. So trying to beat the market. What that means is if you feel like the market is going to go down, you're trying to sell at your gains in a timely fashion. There is no historic data that anyone has really ever beat the market. So trying to time the market, what we call market timing, with the whole buy low, sell high, acting on emotion, is really not a good strategy. When I started in this industry, it was probably the first phrase I was taught was buy low, sell high. It doesn't work that way in a long-range plan. So, leaving emotion out of the investing is a difficult concept, and it's not going to work. It would be like leaving emotion out of a marriage or a friendship. But in the end, if you use emotion, you may end up buying high and selling low. Don't let fear be your investment strategy. So one of the recommendations we always make is set a risk tolerance for yourself and invest with a risk tolerance that you are going to be able to sleep at night. When you start letting fear as the market fluctuates dictate your investments, you will lose. So capturing the right investment risk tolerance and feeling comfortable with the risk that you've taken on and the reward that you'll receive for that risk is a good strategy, and not letting fear drive your investment decisions. Not investing early enough. I can't say this enough. It's never too soon, and there's never too little to start saving and start investing. We definitely recommend that, a portion of your income that you can put aside should be saved for retirement. Investing too conservatively. So, as I mentioned earlier, putting money under the mattress. That is a conservative investment in that, other than theft or fire, your money will still be there, but you lose all the upside potential by not investing in something that can offer growth. And most importantly, in my mind, is not understanding how a financial advisor that you engage with is paid. Oftentimes, the way that compensation works in the brokerage and financial industry is very convoluted. It's pages and pages upon legalese that you would have to read to understand the compensation of your financial advisor. And understanding how they're paid can help you understand if you're on the same side of the table as them. So as your portfolio grows, does their compensation grow? If your portfolio shrinks, does their compensation shrink? And are you paying for the service you're receiving? So Bonnie will go on to talk about what we call the periodic chart of investing. Bonnie, I'll turn that back over to you.
Okay, thanks, Carrie. This periodic table, and it is difficult to see. The printed copy you'll be able to get after the presentation today, may be a little bit easier. But if you look at the colors, what this is designed to do is to show us from 2001 through 2015 which type of investment has performed the best. Is it a stock? Is it a bond? What kind of stock is it? Big company, small company, domestic, international? And we're calling this Find the Preventable Investment Mistakes page, because if you think about what Carrie just discussed, what might people be trying to do in terms of timing the market? Okay, well, maybe the answer is in 2015, what's at the very top of our box for the best performer? Oh, good, it's small growth stocks, small companies that we expect to have significant upside in their business plan. So therefore, if I want to do a preventable investment mistake, I might decide small cap does best, I'm always going to invest in it. Well, it was great in 2015, but if you look at that light green color in 2014, you'll see it was below the midpoint of successful performance. You'll find other years where it fell even lower. So this chart is a way to kind of internalize and to visualize some of what Carrie just discussed. Current performance, no guarantee or reflection of what's going to go on in the future, or past performance either. What markets are up in 1 year? I missed a rise in 2014 in real estate investment trust. Look at that, it's at the top of the heap. So now it's 2015, I'm going to buy them. Well, it's fourth from the bottom in 2015. So look at what happens with this. Just follow the colors, follow the up and down arrows, and you'll understand that any of the strategies that we just discussed probably are not going to work for you. Letting fear be your investment strategy. If you say, I'm scared of anything other than big companies, what does that mean? Well, if we look across the top performers in a lot of years, it's been commodities, it's been real estate. Emerging markets, those are the small, not your UK market. it's what's going on in some almost third world countries. They have done very well because they're more aggressive. So if you're letting fear be your investment strategy alone, you're not going to be in some of those areas, and therefore your overall performance won't be as strong. Not investing early enough. If you hadn't started investing, and Karen made that point, you're going to miss all of these things. So start early, and small amounts are fine. And I think the biggest thing we as women tend to do is invest too conservatively because a variety of reasons. We feel we don't understand the markets. We don't know enough about investing. We're afraid of a loss because we're thinking about the number rather than the goal. So I frequently see young women in their late 20s, early 30s who are so afraid of loss they have 401ks in a fixed income portfolio when they're looking at 35 to 40 years before they need the money. So if you're letting fear be your investment strategy and investing too conservatively, what you're going to do is to be into treasury bonds perhaps, and you'll see where those are in the chart, almost always at the bottom one or two. So it doesn't work. I think this chart's kind of the representation of that. Has a lot of other things. It's hard to see in this type of format. But look at it, look at what we said, where it could be some investment mistakes, and I think you'll see all of them represented on this chart. So if you've decided you're more comfortable with the investing and financial planning process, where do you start? How do you find an advisor, and what are important things to think about? Carrie?
Thanks, Bonnie. The first place to start is to define your goals. What are your short-term and long-term goals? And those are different for every person. We work with some Gold Star wives that their goals are just to make their rent. And we work with some widows that have long-term care goals, that they want to ensure that they will have adequate health care throughout the course of their life without running out of money. So defining your goals, short-term and long-term, is the first step. Basic financial planning 101, pay yourself first. Take a portion of your pay and maximize savings that is tax-deferred, TSP, any kind of 401k. Paying yourself first is always a good strategy. Start saving now, save early, save often. Finding a professional to assist you. And, excuse me, this again is not a one-size-fits-all. So when you look for a financial professional, you have to be sure that this is someone that you're comfortable working with, that it's someone that you can have an open dialogue with and that you feel comfortable with. Money and finance is very personal. You wouldn't seek a doctor that you were uncomfortable speaking about your health condition with. You have to be able to be comfortable with the advisor that you've hired. But more importantly, once you've found someone that you're comfortable with, you should ensure that this person is well qualified to handle your finances. So the qualifications that you would want to ask and learn about that financial professional is, are they licensed? By whom? What organization oversees their professional license and designation that make them qualified to handle your financial affairs? You can ask them for references. Most financial advisors out there will have a group of clients that are happy to provide references on the services that they've received. And you can do research to check and be sure that no regulatory complaints or sanctions have been filed against the financial advisor. Most financial advisors, if they're working in a brokerage capacity, have what's called a U4, and you can look that right up online by doing a Google search for broker check, and that will ensure that they have not violated any regulatory requirements or have had any complaints by clients filed against them. Some questions that are helpful to ask when you are looking for a financial professional and interviewing them is, what are their fees? In plain language, not in 3 pages of legalese. How are they compensated? So if the fee is one number, what percentage of that fee are they compensated, and how is that calculated? This is a new one that is still in the process of working its way through the financial system, but are they subject to a fiduciary standard? So there's been legislation that's been talked about, is working its way through the big firms to be implemented, that all financial professionals should be held to a fiduciary standard. And what that means is a standard of prudence and care that says that the recommendations that you are making are always in the best interest of your client. That standard has not existed in the past in our industry for financial advisors in a brokerage firm. They've always existed in firms that serve as a fiduciary, such as trust companies, AAFMAA Wealth Management and Trust. So they're trying to implement that across the board in some of these larger institutions, making that any recommendation must be and remain in the best interest of the client who the recommendation is made for. The Prudent Investor Act, prior to this fiduciary standard, said that the recommendation had to be appropriate and prudent at the time that the recommendation was made. That did not mean that there was any standard of care to ensure that the recommendation or the investment that was made stayed and remained a good and prudent investment as time went on. So asking that question, are you subject to the fiduciary standard, allows you to understand if their recommendation is something they'll monitor over time versus just putting your assets into a financial investment program and letting it run on autopilot. Asking them what their investment philosophy is. Different advisors have very, very different ideas about how to invest their clients' assets. And so understanding their individual philosophy or their firm's philosophy and ensuring that it matches your philosophy, it is fundamental to picking the right advisor. When we talk about investment philosophy with our clients, we talk about the fact that we're not market timers, we are not chasing the highest highs, we are always protecting the downside exposure. So our portfolios may not be the highest returning portfolios on the street, but when the street is down 20%, we are happy that our clients may only be down 7%, 10%. So that's a philosophy that we take. Matching your philosophy with your professional advisor is very important. And finally, we say, ask what their typical account size is. You don't want to feel like a little fish in the big ocean. You don't want to feel that you are working with an advisor who has much larger clients that dominate their time or that are more important to them to reach out to. So feel like you're working with somebody that is respectful of your investments and your size account. And Bonnie, I'll let you continue with where to begin with choosing a financial advisor.
Well, what we've done is talked about what you should be asking prospective advisors. There's a lot of questions that prospective advisors should be asking you as well. And if they don't, you need to think about the chance of a long-term relationship here. They should be asking you, what are your goals? We've talked about the importance in setting your goals So a prospective advisor should ask you, what are your goals? Not what return do you expect? What are you trying to accomplish in the great scheme of things? When will you need the invested funds? Because if you say, you know what, my kid starts college in 2 years and I need that money then, you should be getting a very different investment discussion than if you say, this is for my retirement and I don't need it for 20 years. What is your tolerance for risk? And there's a lot of ways to measure that, a lot of ways to test for it and to discuss it. But if you're not having these basic discussions with a prospective advisor, you're not going to be getting the type of advice and long-term relationship that you really should be looking for. Someone should ask you, are there any assets or asset classes you would prefer not to own? There's something called socially responsible investing, where some people don't want tobacco stocks, or they don't want stocks in companies that develop weapons. So you may not have those objections, but a prospective advisor should be asking you those. You ask your questions, he or she should be asking you his or hers. And you need to feel comfortable with your advisor. Overall, we're hoping this is going to be a long-time relationship. Remember, you don't always marry your high school sweetheart. So you may have someone that you think is going to be great, and then you ask some of these questions, and it's not really working out. You're not on the same page. They don't work with clients of your size or experience level, or they're not asking you the basic questions. Look at it this way. Managing your money is a job, and you are hiring a new employee to assist you with that job. What would you ask someone that you're looking to hire on? If a prospective advisor intimidates or talks down to you, keep looking. That's starting to change, but it's been a problem for a long time in financial services industry. And every advisor has been in meetings where husband and wife are there, and 100% of the conversation is directed to the husband. If you're looking for a long-term relationship, that's probably not going to be working. So if you feel you're being talked down to, keep looking. There's a lot of other advisors out there. On the other hand, if the relationship isn't going well and you've given it time, don't be afraid to look elsewhere. There's nothing wrong with changing advisors. If you're just saying, you've lost me money and the markets have been down, you need to have a deeper discussion, because that might not be the responsibility or liability of the individual advisor. But what you're trying to build, your goals are long-term goals. You should be looking to establish a long-term relationship for advice as well. So give it time, but if you feel it just isn't working out, remember, this is a relationship. Don't be afraid to look elsewhere. Don't only ask for things in a quantitative, a numbers way. Again, remember, risk tolerance, you may be given a lovely little sheet to fill out and you score on a risk tolerance level, but the discussion needs to go far beyond that. It's not just numbers, it's the whole personal relationship. It is the subjective side that is extremely important. So let's say you have found your advisor, you're ready to launch into investing or financial planning. What should your first steps be in that new relationship? Carrie?
Thanks, Bonnie. So the first step is to create a plan. You've talked about setting your goals. So create the plan that is goal-driven, that is planning for your generation first, and sets limits on helping your kids. Many times I've had to tell people that you can finance children's education. Most people don't want to see their children graduate with student loan debt, but you cannot borrow for retirement. So, plan for yourself first and then help children. Consider asset allocation and diversification. Probably the number one driver in investing success is to have a well-diversified asset allocation in portfolio that has, Bonnie did the periodic table that has portions of all different investments in it, so that as one sector moves up and another sector may not be performing as well, you have exposure on all sides, so that you are not in the one sector that has decided to be the high performer one year and the lowest performer the next. I mentioned this before, and I can't mention this enough. Tax advantage saving structures, TSP, 401ks, anything that's tax deferred is a win-win. You are saving money without paying taxes on it, and that is a huge advantage in the end. When we do financial plans and we show people their TSP or their 401k funds and how they look, into their 70s and 80s, it is a shocking disparity between the taxable portion of their investments and the tax deferred. So I can't stress enough taking full advantage of any kind of tax deferred investments that you can make: IRA, Roth IRA, 401k, TSP. Understand and discuss SBP and other retirement elections. This is really important. SBP has various options as far as the percentage that you will elect to provide for your surviving spouse, or your spouse will provide for you, and the cost. So there's an analysis on how much you pay out of your retirement benefits to be, awarded to your surviving spouse when you pass. And that analysis is very important. Do they need all 55% of your SBP to make ends meet every month, or is there some lesser value that you can live on and pay less now? Consider life expectancy. We're living longer, so with these, people living well into their 90s, 95, even into, over 100, can you outlive your money and certainly look at potential long-term care events? Medical benefits through the government do not cover long-term care events. So long-term care insurance is a consideration. Your age and your health are a consideration on whether that's affordable, but that has been something that has certainly taken a lot of people's financial plans for a roller coaster ride if a long-term care event happens. So once you've created the plan and you've considered these things that we've discussed, it's time to start implementing the plan. That implementation does not have to occur all at once. It would be quite overwhelming to say that you have to start all your savings and all of your budgeting and adherence to a monthly figure all at once. But baby steps and, working towards that goal and that implementation are what's most important, and that you determine what works for you. So you're going to implement the plan, but what step do you take first? What step is second? Making those types of determinations is where you begin. And Bonnie, back over to you.
Okay. So once we have a plan, I guess good news, bad news. You've done the plan. You've given a lot of thought to your goals. You've developed a strategy to get there. It's not over. We talked off at the very beginning by saying how money is a relationship that can't be left alone. It takes time to grow. You nurture it, and here's where you are. You review your plan frequently and make sure you're adjusting for major life changes. Death of a spouse. A lot of financial issues that come up along with the emotional. What's going to happen with an existing asset allocation, existing beneficiaries? Do you have more funds to manage now? So make sure you're looking at your financial planning considerations. Children completing college. You may no longer have that bill that you've been footing for all those years. So what does that mean for your own personal planning? You inherit some funds. May make life a lot easier, but how do you invest it? Should you be paying off debt? If you have the misfortune to become disabled, what does that mean in terms of your cash flow, in terms of additional expense needs? Or you have a significant reduction in debt. Let's say from that inheritance you pay off your mortgage. It means you need to look at the rest of your assets a little bit differently. this list is by no means complete when it comes down to major life changes, but what it's meant to indicate is whatever financial planning you've done will not be your final plan. And that the process of financial planning, of understanding your money, of making investment decisions really never ends. We started off again by saying there's no one right answer. Well, there's no one right point where it all ends. So the process doesn't end, and the questions never end. And Winnie, I believe we have a few minutes left for questions if you have any for us.
Yes, thank you, Bonnie and Carrie, for the wonderful presentation. Now, what are your questions? We have collected a few questions already, but please don't hesitate to ask other by emailing us later on. Right now, I'll leave Bonnie and Carrie's contact information here while we go through the Q&A. So, first question we have here is, with similar risk tolerance, would my portfolio look different than my husband's?
Okay, I'll take that one. Yeah, I got it. You know, I'm a lawyer, so a lot of my answers say it depends, but here, you know, it really does depend. What I would say is, you know, the ending might be similar. The type of portfolio that's recommended for you might look pretty much the same, but you're going to get there in a very different way. Remember, we talked about the importance how women tend to think more in terms of goals rather than numbers. So some portfolio design might be, I need 8%. No, your portfolio design is going to be, I need to achieve a certain goal. Women, I think, are less linear in how they think about that. So you might end up with a similar looking portfolio, but there are a lot of other variables. The biggest thing, and we haven't really focused on it because it seems so obvious, women's life expectancy is just longer actuarially than it is for men. So remember that we said 70% of boomer women will probably survive their partner or spouse. So you have a longer life expectancy to focus on. And that the need for the use of money over a longer period of time frequently may lead you to a different asset allocation despite your risk tolerance. And it can be for one of two reasons. One, you need to invest a little bit more aggressively early on to ensure that that money is going to remain available. And that's the primary driver. So risk tolerance is part of an asset allocation decision, but the need for the use of money and how long it needs to be available for you is a big driver. So you may end up with something similar, but you also might be asked to take a little bit more risk to make sure the money is going to be there for a longer lifespan.
Great, thank you, Bonnie. The second question we have is, should I only use a woman advisor?
Okay, this is Carrie Winnie, and I'll take that question. The simple answer is not necessarily. I spoke earlier about some of the qualifications that you should look for in an advisor, their experience, your comfort level with them. Some women choose male doctors, so you have to feel comfortable with the advisor. They don't need to be a man or a woman, you know, one or the other, whatever your comfort level is. And the process for selecting an advisor to work with is no different for men or women. So a man should use the same process in selecting an advisor as a woman should use. What's their experience, what's your comfort level with them, how they charge fees, all of the questions we mentioned earlier. But there is no one right advisor, male or female, for women. It is the process of finding the right person.
Great, thank you for your answer. One last question. My husband handles all of our investments. While this presentation was enlightening, what practical applications can someone in my situation take away from this? Additionally, what can my husband learn from this?
Okay, this is Bonnie. I'll take that one, Winnie. I think education is certainly the answer to point one. As a practical application, the more that you know as a prospective investor, as a partner in a financial plan, the more comfortable you are going to be. The more you know about what elements to consider in developing a portfolio, the more engaged you should be. And I think I mentioned before, one of the most important things is for women to become more engaged in understanding the process. Because if you don't understand it and tend to sit back and let a spouse or partner take charge, you're going to be in what we call a what do I do now situation at some point, where if you are part of that 70% that survive a spouse or partner, it is going to be on you. So the knowledge is extremely valuable. Understand what the elements are. How did you get to the asset allocation you have? So the more you know about that, I think the more comfortable you will be at some point when you may be asked to be managing this on your own. In terms of what your husband can learn from this, I think the questions are always the same. Picking an advisor, Carrie suggested, the questions are the same, the considerations are the same. So I think not focusing on numbers may be partly valuable, but the need to think about who your advisor is and the need to continually review. Do not expect anything to run on autopilot, I think, is a very valuable lesson for everybody.
Great. Thanks, Bonnie. Those are great questions. And if we didn't fully answer everyone's questions, and if you think of another question later on, please reach out to us at wealthmanagement@afma.com. We'll go ahead and break here for now, but you can reach us whenever you need to. Please do not hesitate to ask for help. This is what we do, and we love it. This weekend, you receive a follow-up email with instructions on how to access a recording of this presentation. And you can always sign up for future webinars or review past webinars at wealth.afma.com. If you found this information useful, please share it with your friends and family. Our membership grows stronger every year because you introduced your friends to AAFMAA. Thank you so much and have a great day.